FAR.F2.M6.
Fair value. Jenna, this is one of those topics that sounds like it should be simple. What's something worth? Easy. But then accounting steps in and says actually it depends. That's where I start getting suspicious.
And that's exactly why this module exists, Russell. Fair value isn't trying to answer, what do you think it's worth? It's answering one very specific question. What price would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date? If you lock onto that definition, almost everything else falls into place.
I already heard something people are going to miss. You didn't say buy.
Exactly. Becker emphasizes that fair value is an exit price, not an entry price. That's one of the biggest mental anchors for this entire chapter. We're imagining leaving the asset behind, not acquiring it.
So, if I buy a building for $2 million today, fair value isn't automatically $2 million tomorrow.
Correct. Tomorrow's fair value depends on what the market would pay for it tomorrow. Fair value is market-based, not entity-based. Your personal plans, your financing, or how much you love the asset don't determine fair value.
That reminds me of selling a used car. I don't get to say, well, I really need $40,000 because I still owe that much on the loan.
That's actually a really good analogy. The market doesn't care about your circumstances. Buyers pay what the market says the car is worth, not what solves your financial problems.
So, fair value is basically the market saying, nice story. Here's the actual price.
Pretty much.
The definition also says an orderly transaction. Why do they bother saying that?
Because Becker doesn't want you picturing a fire sale or a forced liquidation. An orderly transaction assumes normal market exposure and normal selling conditions. If someone has to dump an asset immediately because they're desperate for cash, that price isn't representative of fair value.
So, we're pretending everyone involved has enough time to negotiate like rational adults.
Exactly. That's also why the definition refers to market participants. These are independent buyers and sellers who are knowledgeable, willing, and acting in their own economic best interest.
Not your cousin doing you a favor.
Definitely not your cousin doing you a favor.
Now let's talk about markets because Becker introduces two that sound almost identical. Principal market and most advantageous market. Those names are practically begging students to confuse them.
And they often do. Start with the principal market. That's simply the market with the greatest volume and level of activity for that asset or liability.
Basically where the item normally trades.
Right, if a principal market exists, you're done. You measure fair value using that market, even if another market would technically give you a slightly better outcome.
Wait, really?
Really?
That feels backwards.
It does at first. But the idea is consistency. If everyone uses the market where trading normally occurs, financial statements become more comparable.
Okay, then when does the most advantageous market matter?
Only if there isn't a principal market. Then you look for the market that gives the best overall result after considering transaction costs.
Here's the part that always catches people. Transaction costs help identify the most advantageous market.
But they're not included in the fair value itself.
Exactly. That's such an exam trap.
Becker's example illustrates this perfectly. You may compare markets using transaction costs to determine which market is most advantageous. But once you've identified the appropriate market, fair value itself is measured without deducting those transaction costs.
So, transaction costs help pick the stadium, but they don't change the score.
I like that analogy. Just remember where it breaks down. Transportation costs may sometimes affect the asset's location, but transaction costs themselves aren't part of fair value.
Now we get to what might be the weirdest phrase in the chapter. Highest and best use. It sounds like a motivational seminar.
It really does. But highest and best use has a very specific meaning for non-financial assets. Fair value assumes the asset will be used in the way that maximizes its value from a market participant's perspective.
Not necessarily how the current owner is using it.
Exactly. Suppose a factory sits on land that's become incredibly valuable for luxury apartments. The current owner may still be manufacturing products there, but the market may value that land much higher if it's redeveloped.
So accounting is asking, what would the market do with this asset? Not, what is management doing?
That's the idea.
But Becker immediately says this mostly applies to non-financial assets.
Right. Financial assets and liabilities generally don't have different alternative uses. A share of stock is a share of stock. A bond is a bond. The concept of highest and best use is mainly relevant for assets like land and buildings.
Good distinction. Now, let's move into the framework itself. This is where Becker says there are 3 valuation approaches.
Market approach, income approach, cost approach. Those are the 3.
Here's something that confused me years ago. People mix these up with levels 1, 2, and 3.
Exactly. They are completely different ideas. The valuation approaches describe how you estimate fair value. The hierarchy describes the quality of the inputs you're using. Different concepts.
Let's walk through the approaches first. Market approach.
Uses prices and information from market transactions involving identical or comparable assets and liabilities. Think, what has the market already told us?
Income approach.
Converts expected future cash flows or earnings into a present value measurement. The focus shifts from today's observable prices to today's value of future economic benefits.
Cost approach.
Looks at current replacement cost, essentially asking what it would cost today to replace the service capacity of the asset.
3 completely different ways to estimate value depending on the situation.
Exactly.
Now comes what I think is probably the highest yield part of this module, the hierarchy.
I agree. If listeners remember nothing else, remember this ladder. Level 1, Level 2, Level 3. And as you go down the ladder, the inputs become less observable and more judgmental.
That's the mental picture. Climbing downward means climbing into uncertainty.
Perfect. Level 1 uses quoted prices in active markets for identical assets or liabilities. This is the gold standard. Little estimation, little judgment, maximum market evidence.
Think publicly traded stock with an active quoted price. You don't need to guess. The market already answered the question.
Exactly. Level 2 is where things become slightly less direct. You still have observable inputs, but maybe they're for similar assets, inactive markets, or other observable market information.
So, you're still leaning on the market. You're just not getting the perfect answer handed to you.
Exactly. Then comes Level 3. This is where observable market information isn't available. Management has to rely much more heavily on assumptions and internal estimates.
Which naturally increases estimation uncertainty.
Exactly. Notice Becker never says Level 3 is wrong. It's simply less objective because market evidence isn't available.
Here's an analogy. Imagine estimating the value of a house. Level 1 is identical houses on your street selling this afternoon. Level 2 is similar houses nearby selling recently. Level 3 is saying, well, based on what I think buyers probably want. Quote.
That's actually an excellent way to visualize it. Just remember that accounting doesn't automatically choose Level 3 because it feels easier. You always use the most observable inputs available. Level 3 is essentially the last resort when Levels 1 and 2 aren't available.
That's another exam trap. You don't pick your favorite level. You use the highest quality inputs you can reasonably obtain.
Exactly.
Now, Becker also talks about disclosures. Why?
Because users of financial statements need to understand how fair values were determined. It's not enough to simply report a number. Users benefit from understanding the valuation techniques, important assumptions, uncertainties, and how changes in fair value measurements affect the company.
So, disclosures answer the question, how confident should I be in this number?
That's a nice way to think about it. The farther you move toward Level 3 inputs, the more users appreciate understanding the assumptions that produce the measurement.
There's another point the outline highlights. Exceptions.
Right. The outline notes that an entity may be exempt from fair value measurement when measuring fair value isn't practical, cannot reasonably be determined, or cannot be measured with sufficient reliability. For this module, simply recognize that exceptions exist. The emphasis remains understanding the overall framework.
Before we wrap up, let's build one final mental map. If I see a fair value question on the exam, what's my sequence?
I'd ask 5 questions. First, remember fair value is an exit price. Second, identify the correct market. Use the principal market if one exists. Only consider the most advantageous market if no principal market exists. Third, determine which valuation approach makes sense. Fourth, identify the quality of the inputs using the Level 1, Level 2, or Level 3 hierarchy. Finally, remember that disclosures explain how the measurement was developed and the uncertainty surrounding it.
I like that. It's almost like building a house. First, decide what you're trying to build. Second, decide where you're building it. Third, decide what tools you're using. Fourth, evaluate how reliable your measurements are.
That's a helpful framework. Just don't confuse the valuation approach with a hierarchy. The approach is the tool. The hierarchy evaluates the quality of the information feeding that tool.
That might be my biggest takeaway from this module. Approach versus hierarchy. People blend those together all the time.
And Becker keeps them separate for a reason. The approaches explain how value is estimated. The hierarchy explains how observable the supporting inputs are. Different questions, different answers.
So if listeners leave today remembering only a handful of things, I'd vote for these. Exit price, orderly transaction, principal market before most advantageous market, highest and best use for non-financial assets, 3 valuation approaches, 3 input levels.
I completely agree. Those concepts form the backbone of fair value measurements. Once you understand the logic behind them, instead of memorizing isolated definitions, the chapter becomes much more intuitive and much easier to navigate on the FAR exam.